Good morning. It is Friday, May 17th, 2019, and we are going to learn just how bad of an investor Warren Buffett is today. He's a bad, bad investor. He doesn't know what he's doing, betting on oil. So let's take a look at the Occidental and Anadarko merger takeover right now, and go through some of the articles that have been written about it. I'm not even going to touch on T. Rowe Price too much. T. Rowe Price sold off all of their Occidental Petroleum holdings because they think that Occidental made a mistake in acquiring Anadarko. And the manager over at T. Rowe Price is being intellectually dishonest with you. I can tell you right now that T. Rowe Price might believe that the end of the oil age is far further along than other people do, and they may just want to get rid of oil holdings. But for them to dump Occidental on the premise that the acquisition was a bad acquisition, well, there's a term for that I keep hearing from old farmers, and it's called bullshit. They may have wanted Occidental to be the company that got acquired, but when Occidental decided to acquire, they ran away, and the manager of that fund, who will go unnamed, but you can look him up, frankly is a knucklehead, especially if you take a look at his track record. He doesn't understand the company. He said he doesn't understand what's going on, and he bailed. So, you've got an MBA stuff suit who decided that, hey, I'm going to be profound and be smarter than everybody else, and I'm going to say that this is a bad deal. Now, he's not alone. There were some hedge funds and some Seeking Alpha writers and Fortune and Forbes. There's a lot of writers out there saying that it's a bad deal. But none of them were able to write a $10 billion check. So let's take a look at what's really going on with that Occidental and Anadarko combination, because I think it's a great deal for Occidental. If you believe that oil demand will continue to increase even ever so slightly for about the next decade, and if you believe that oil is not quite as abundant in the intermediate and longer term as it is right now because of the new discoveries in shale, and if you believe that the financial industry and financing for oil projects is going to remain tight, then you can only come to one conclusion at the end of this, and that's oil and oil stocks are going to do pretty well for the next several years at least, even if you're like me and believe that we're in the second inning of the end of the oil age. Now, it's taken 6 years to go from batting practice to second inning. I think about the second inning. It might be the first inning. But in any case, that means that we still have years and years and really decades to go before we wean ourselves off of oil. In fact, when you take a look at the chart that I've put up a number of times, I believe that we hit this supply-demand balance in the 2020s, and that maintains a firm oil price that not only propels oil stock earnings, especially the low debt companies with the best assets, but the alternative energy and EVs. Because if oil is going to be hovering around 60, 70, 80, 90, $100 a barrel versus 30, 40, 50, and I think that that's a no-brainer that it's going to be in that 60 to 100 range, then what happens? That means that there's a lot of winners, but there's also potentially losers at the end of the day. And that's why we don't want to be in oil forever. We look at it as a position trade, and I will probably exit my oil at some point. I have some leverage on oil stocks right now, really because I believe that we will get quite a few mergers and acquisitions. So let's take a look at what's coming. So we'll finish with this, but we'll use Occidental and Anadarko to make some points here. So what have the headlines been? This article from Fortune is basically saying that oil is going to stay relatively cheap, and that this was a bad deal because everybody should be a seller. I'm not sure how that would work. You have this article here, and she doesn't understand what she's talking about. I've read a number of her articles, and she is a checkerboard player. She plays checkers. She doesn't understand what a good price for this would be. She doesn't understand how synergies work. Frankly, she's just trying to make a buck because she's a good writer, and she doesn't really understand what she's talking about. A lot of people saying this. Some Argus guy, Occidental overpaying for Anadarko. How come? Why? Because he says the $3.5 billion of cost synergies they're not going to be able to make up. I'll show you later that not only will they get the $3.5 billion, they'll probably get well into the fours, and if not over $5 billion in cost synergies and savings. Oh, I got to this a little too early. So we have people at Seeking Alpha, Forbes, Fitzsimmons, I believe was another one. I must have closed that link. Saying that the Occidental acquisition of Anadarko is too expensive. But I've made the point that, and now Pioneer CEO is saying the same thing, that Chevron was just bottom fishing. And that is what they were doing. They were trying to get a super cheap price on Anadarko, a price that was below the highs from the last 2 years, significantly. And for folks to say that Occidental overpaid, all you have to do is really look at the chart and see that they're probably getting a pretty good deal if you think that Anadarko is going to go back to its highs eventually. No guarantees of that, of course, but Scott Sheffield is a pretty astute guy. And when he gave his earnings a week ago or 2 weeks ago, he said, hey, we're not for sale. Why would he say that? Same reason an NBA player says, I might retire. Oh, wait, maybe I'll take one more contract for $25 million a year, right? It's leverage, it's negotiating, and by all means, Pioneer is for sale at the right price. But they're not going to allow Exxon or Chevron to come in and say, hey, let us give you this crappy deal, and why don't you guys set up an exit bonus and pay yourselves and screw the shareholders, which is really what the Anadarko management did. The Anadarko management should be thrown in jail. They should be required to give their money back, and they should be barred from ever working in any financial or energy industry ever again. That's how serious I think that is. The day before Anadarko announced the merger with Chevron, they voted themselves multi tens of millions of dollars in bonuses if there was a change in control of the company. So not only did they act on insider information, they were just dicks. They're taking shareholder money. And ultimately, what the guys at Anadarko did that got them paid cost the shareholders $1 billion. $1 billion. So they could get their tens of millions. If the Securities and Exchange Commission is worth anything, if the Justice Department is worth anything, they ought to be cracking down on executives that engage in thievery from shareholders. I call it the big skim. And if anybody out there doesn't think that it's going on over and over and over again, take a look at the articles that just came out on the top paid CEOs. Seriously, hundreds of millions of dollars these guys are earning. Are any one of these guys worth it? Are any one of them adding that kind of value? Not a single one. Not even Elon Musk adds that kind of value. And he's probably the one that adds the most value because, as I've described in the past, the guy farts money. Whenever Tesla needs money from the market, he says, hey, smell this. And they say, ooh, I want that. I want what you were eating. So, Elon Musk probably deserves to be paid the most based on the value he adds. But the question is he still on a winning team, right? So when you vote for MVP, you generally vote for somebody on a winning team. We think Tesla's going to be on the winning team, is the winning team. I think they are. I think Tesla's going to 1,000. But, $500 million for Musk a couple of years ago, $230 million for the Tilray cannabis guy. It's freaking marijuana. Cheech and Chong would be proud of this guy. $230 million that guy made. Bullshit. So you as shareholders, if you're not going to start voting against these pay raises, don't you ever complain about what these company managements are doing. Because you get what you deserve. I vote against these pay raises all the time because I get to vote client shares. And these guys are running roughshod, not over to shareholders, but you take a look at some of the pharma companies that are out there and some of the other companies, really, it's a lot of companies. JP Morgan. Jamie Dimon's a billionaire now. Helped lead the world into the last financial crisis. He's going to help lead it into the next one. Underpays his people across the board. Gets a little bit of each piece that they should have been making. The big skim. That's what it is. It's a big skim. I'm Italian. I'm telling you, I recognize this stuff. Anyway, back to Occidental and Anadarko. Chevron was just trying to get a bottom fishing price. Now, we like that, right? As as people looking to buy stocks with some growth but also a value price, we like to bottom fish. In fact, in my spreadsheets, I call it bottom fishing. That's what Chevron was doing. So to say that Occidental overpaid because they paid a little bit more than the bottom fishing price doesn't make any sense, Laura. Or Fitzsimmons. Let's call this guy out too. This guy. This guy doesn't know what he's talking about either. I've played nice with a lot of people for a long time because it was my New Year's resolution a few years ago to try to be more diplomatic. I've tried. Look, man, I had a minister tell me about 20 years ago, Kirk, you don't suffer fools very well. And I don't. And I know that I get grumpy once in a while. And I'm going to be a spectacular old man. But Fitzsimmons, he doesn't get it either, right? We are not in an age of energy abundance. We really aren't. We could be if we'd embrace alternative energy, but we don't because the entrenched interests are just so strong that we don't care about burning up the planet. We don't care about energy independence. We don't care about keeping our troops out of the Middle East. We don't care about any of that. Because if we really did, we'd make some changes, especially now that the technology is there. And when I say that the technology is there, we already covered that there is a utility in Indiana that's the first, won't be the last, tearing down a coal-fired power plant to replace it with solar, wind, and batteries. Why? Because it's actually cheaper to do that. It's cheaper to build the new alternative energy infrastructure than it is to keep shoveling coal into some of the power plants. And in fact, those lines are crossing right now across the board. You're going to see coal-fired power plants get torn down at record rates. Actually, we're already at a record rate, but it's going to be even faster 2-3 years from now. You're going to see the complete destruction of the coal industry, and that's going to provide us some ability to short. Hopefully some smart politician out there, rather than saying, hey, I'm going to save the coal jobs, is going to say, hey, how about I give you a couple extra, how about the government give you a couple extra bucks on your unemployment, stretch it out, give you some education benefits, make sure you can feed your family, make sure that you don't lose your house, and transition you into another career, right? You know, solar panels, building the smart grid, whatever. So, you know, there's a lot of changes coming for sure. Coal's going to get wiped out imminently, but oil's got a way to go. So we want to take a look at what really is going on. And in that one article, it said that the Occidental Anadarko deal wasn't a Permian deal. Man, I just don't understand what these people are saying sometimes. Now, Anadarko and Occidental have a lot of property, right? And I'll show you some of those maps in a second. But the reality is that the synergies here are important. And there's actually a better chart in here. So if you want to understand this deal, you should go to Occidental Petroleum, and they have a whole presentation, right? It talks about the deal. If you're an Occidental shareholder or thinking about being one, you need to read this report. It's quick. You know, we'll get through it in a couple minutes. But when I talked about mergers in this last article, and I start showing some of these maps of where everybody's property is, right? Who's overlapping where? It's important to understand that you want acreage that is contiguous. And if not contiguous, at least close. Because then at least if you want to build a lateral, you just go to that guy right there and say, hey, we'll give you a deal on that piece of land because we need a pipe that's going to go underneath your land. Or you say, okay, well, let's see, right here and here, we got a pipe that we want to put under there. Can we buy your land? So in the Permian, there's literally 500 acreage holders, and most of them aren't producing, and they have to get a pipe in the ground at some point, otherwise they lose their rights to the acreage. So Occidental and Anadarko, I mean, that creates a pretty strong play. So what you're going to see Occidental do, is they're going to start filling in some of these gaps, right? They might buy an operator. Occidental might acquire somebody else, might acquire somebody significant. I believe that they will. But you're also going to see them go to these little operators that have 1,000 acres or 500 acres or 640 acres, whatever, and say, hey, we have a well over here and we want to put the lateral out 5,000, 9,000, 8,000 feet, however long they want to do it, and they'll buy that acreage and say, okay, here, we're gonna drill over here, pipe's gonna go underneath where you have rights, let's cut a deal. And they'll cut a deal. So that's what's going on. That's why this was a Permian play. The Permian accounts for virtually all of the new oil production on the continental U.S. Gulf of Mexico is also producing a little bit more. But this is absolutely a Permian deal. Even though, take a look at Anadarko's report. This talks about all the places they have their acreage and operations, right? Operations report, February 2019. This is where they operate in the U.S., overlapped with Occidental, largely. Delaware Basin, this is what they highlight. And then they also have operations all over the world. Gulf of Mexico, international. Now, Occidental already sold the African assets, right? I'll show you that. So when you go to Occidental, right, this is very well laid out. For anybody who doesn't understand this, it's because they haven't looked, right? And I'll use the word ignorant, not in the right way, right? Ignorant doesn't mean stupid. Ignorant means uninformed. And if you're uninformed, here you go, inform yourself. So when you take a look at what they're going to focus on, it's going to be right here. It's going to be these plays, right down this part of the country. So this part of the country here, do you know what that is? Do you know what used to be here? Does anybody know what used to go right down the middle of the country? Give you a hint, it ended in the Gulf of Mexico. Right? There was an inland sea here. And that's why all of our shale plays are here. Because this all used to be underwater, millions of years ago. And that's where all that oil comes from. It was underwater. And that's why when we deep drill in the ocean, there's a lot of oil. Why? Because it's compressed and it's old and it's been, accumulating debris, fossils, for millions of years. So, these guys out there say, well, the Earth doesn't, it's not really fossils. It's just the Earth produces oil. It's just the way it is. Those are the same folks, man. You don't want to get me on a rant today about calling stupid people stupid, because I'd have a lot of fun with it. I'm tired. I think I told you guys my girlfriend had her appendix out a couple days ago, so I've been back and forth to the hospital because there was a small complication. But yeah, stupid people. That Minister Rose is his name. Kirk, you don't suffer fools very well. I've worked on it. I really have. But we'll have fun with that at some point. So anyway, inland sea. That's where all the shale is. And now Occidental is going to be a leader in there. Powder River Basin, pretty good basin. There's another company that we have a little position in, right? Chesapeake Energy, Powder River Basin, and Marcellus, and they probably sell everything else. Occidental's got Powder River Basin, DJ Basin, most of it on the Wyoming side, right? Unita, natural gas, Gulf of Mexico. I think that they probably sell the Gulf of Mexico assets, to be honest with you. I think that they sell these to BP or Royal Dutch Shell or somebody, one of the majors. Because I think that in a couple of years, these are not going to be the most attractive assets. You're going to see dramatic regulation of offshore drilling in a couple of years. And you can hear me now, believe me later, but President Trump's not going to win next year. In fact, he's not going to come close. So he lost by 3 million votes last time. The midterms, the Republicans lost by 6 million votes. President Trump's going to lose by at least 6 million votes. And, that'll plenty cover the 57,000 votes that he got in the 4 states that swung him to the victory. So, and I'll tell you, I'm in Wisconsin and I spent time in Pennsylvania. He's not winning either state. And I spent some time in Florida. I'd be shocked if he won Florida again. So you should anticipate some major regulatory changes in a couple of years. And if you don't, because, oh my God, I'm conservative and I can't imagine a world where Donald Trump doesn't win, look, I would just tell you Donald Trump's not a conservative. If you're a conservative, you know in your heart of hearts, Donald Trump's not a conservative, right? If you like Donald Trump, you like him for other reasons. And that's cool with me. I mean, I think you're wrong on a lot of those things, but whatever, who cares? Let's just face reality from an analytical standpoint and understand he's probably going to lose. He's probably going to lose pretty badly. But regardless, he won by a razor-thin margin in a handful of states that he's unlikely to win again. So I don't think he wins Ohio. I think there's a good chance that John Kasich runs as an independent with Mitt Romney. and they just peel off a couple of states, right? Or Jeb Bush, Kasich and Bush. I mean, there's enough guys in the Republican Party that hates Donald Trump and don't need his money. They don't need the Republican Party money, that they can just take matters into their own hands. And I'm fairly certain that they will. So we'll see. I could even see some of these guys changing parties. So, let's keep up to date. By the way, I did volunteer to work at the Democratic National Committee because it's in Milwaukee, and I just want to see how this thing works. So I'll be down there somewhere talking to somebody about something, and just seeing, if the Republicans were here, I would have volunteered for that too. But Democrats will be in Milwaukee next year for a better part of a month. The convention's only like 5 days or something, but should be interesting. In any case, we should expect regulatory changes. And one of the big regulatory changes is going to be tighter offshore for offshore drilling. Also, we're not going to see as much drilling on public lands with the next administration, right? And if it's not in 2 years, it'll be in 6 years, whatever. It's going to happen. All the trends are in that direction. The demographics point in that direction, right? The young people aren't voting for anti-climate and anti-environment candidates. It's just the way it is. So you can have your view, whatever your view is, but let's take a look at the demographic realities here. Let's take a look at the voting trends. Let's take a look at the legislative trends around the country. Let's take a look at what the corporations themselves are doing, because they basically operate however they want. I mean, they take all the money they want, the executives anyway. They're already moving to alternative energy. So what does that mean for oil? Well, alternative energy doesn't really offset oil until EVs take off. EVs aren't going to take off until they're cheap enough, right? So we know that oil is going to drift a little bit higher in demand for a number of reasons. We'll get to those in a second. But when you take a look at what Occidental's got going on here, that is some great acreage for supplying America and a little bit of exports, right? But remember, Occidental sold their export facility. Why would they do that? Right? They do it because they're stupid? Or they do it because they built it up, got it to the price they wanted, and then sold it? Right? What if the United States really isn't exporting much oil in a couple of years? Right? What if this is a blip? How could that happen? Well, let's take a look. How could that happen? Right now, we have oil supply going up quickly. Why? Because we just brought the Permian online over the last several years. Over the next several years, oil supply growth will fall, right? Still have some growth, but the growth rate will be lower. And by 2022, 23, we're really not going to have any supply growth at all in America. Why? We already know that the Bakken has peaked out. We already know that Eagle Ford is starting to peak out, right? Powder River Basin is new, so that's growing for the moment. Permian is new and gigantic and growing, and new pipes coming. Proximity to the Gulf, right? There are a lot of reasons why the Permian's the leader. But Colorado, that's flattening out. We already know that. All the numbers are showing that most of the other shale plays, other than the brand new ones like the Powder River Basin, are already peaking. And the capital that goes in to maintain the production is becoming marginally less and less profitable. So your leaders in shale will pretty much all be Permian for the next decade, and some Powder River Basin. Eagle Ford is more natural gas liquids, right? Not a huge oil bench there. The Stack Scoop in Oklahoma, when that starts to get brought online heavy, that could, be a little extra, but it's not that big. The problem in Oklahoma is that for whatever reason, geographically, they're more prone to earthquakes. So that would probably bode towards even more regulation than they've already done. They've already limited the injections of the wastewater, and that raises costs. So everything looked through the prism of what does it really cost to do the business. And what we know is that U.S. oil production is peaking out right now. It could go up, this could be a little bit different, but this is about what it's looking like. This is what we experienced, and this is what we're going to probably experience. And it might not be just like that, but, it might wiggle a little, but it'll be something like that, right? So total U.S. oil supply is going to level off. And it's never going to get even up to here, I don't think. Why? Because financially, I don't think we can do it. And if I'm right, and the Democrats can start blocking a lot more stuff, you're not going to see more public lands drilled, which is good because we shouldn't need to do it. Better off building a solar plant. And the Gulf of Mexico, the shallowest and the easiest to get to oil, is gone. There's really nothing on the shelf anymore. You got to go deep water, and that's getting to be more and more expensive and more dangerous, right? It's not hard to pick out examples of where we ruined an awful lot of sea life because there's a leak or an explosion. So going back to this, what is Occidental going to do? What are they going to do? They're going to focus on these assets, and then whatever is most profitable of these assets. But there's every reason to think they sell this, South American deepwater exploration. Every reason to think that they sell this. And they can do this and get a price because other people don't believe that the end of the oil age is going on, right? You have executives that part of their big skim is they got to show growth. You got to make things look a certain way so they get their bonus. So you're going to always have executives who are motivated by greed, who will buy some of these assets with your shareholder money, get themselves a bonus, and then what do they care? They take their golden parachute and they go home. I think that most of these assets get sold. Colombia, I'm not so sure about, but I think they sell virtually all this stuff. So they said that they would have $10 to $15 billion of divestitures in one day, right? Can you hear that? One day, $8.8 billion they raised. A couple days after they got the $10 billion from Buffett. Oh, Buffett. That's right. We're supposed to be talking about how dumb he is. So they were able to get $8.8 billion. They really are on the hook only for the interest to Buffett. And he has warrants at $62.50. Where is that? Berkshire Hathaway financing. So his warrants are at $62.50. So for Buffett to make money on the warrants, which is where the real money is for him, he needs the stock to go significantly over $62.50. Think about the GE deal, Goldman Sachs deal, and some of the other deals he did that were similar to this. All those stocks rallied big time, right? GE even rallied despite being a wrecked company. Goldman Sachs rallied, right? So will Occidental go to $100 a share and stay there in perpetuity? Yeah, probably not. Most companies go away at some point. End of the oil age will eventually get here. We'll eventually get to the ninth inning. The stocks will probably reflect it in the fifth or sixth. You should expect Occidental to get significantly above $62.50, and it's trading for $54, $55 right now. Occidental's an easy buy right now. And by the way, they got 5% dividend. So, right, Occidental deal looks similar to the Goldman and GE deals. Go ahead and read this in the Wall Street Journal. It's pretty interesting if you think it through. So, yeah. Buffett didn't quite understand that packaged food is going through a slump. Although he's probably right in the long term we go back to it. But we'll see. It'll just be healthier packaged food. Right? So what is Buffett saying? Buffett is saying that this is a bet on oil prices over the long term. Why? Again, I already said this. Regulations are going to make it tougher to drill oil globally. Globally, not just the United States. And the easiest to get reserves are already gone. That's proven over and over again. We've been high grading the shale plays, been drilling the cheapest, best oil to get out of the shale plays. And now the Bakken is flattening out. Eagle Ford is flattening out. Permian, because it's new and gigantic, still growing, flatten out in a few years. And Powder River Basin is growing. Again, not that big, and it'll flatten out in a few years. Colorado already flattening out, and there's a regulatory issue there, right? Wyoming is very friendly to energy. So the DJ Basin on one side of the state and Powder River Basin on the other side of the state, probably going to do all right for a while. The IEA, and I wish this chart was just a little bit bigger. Is showing that we have a little bit of extra oil demand short term, then it's going to flatten out, and then supply demand will pass it up again. So the lines crisscross, right? Because markets change. It's just like farmers with their planting. They see what the demand is one year, they adjust for the next year. Oil has a natural flattening that will occur in a few years once the shale plays are not quite as prolific. And we got that report from Saudi Arabia. They don't have as much oil as everybody thought, right? They finally owned up to it. So what is world oil demand growth by region, right? China. Other Asia includes India. Other emerging markets. So emerging markets, India, China, a lot of growing oil demand. Hundreds of millions of people, right? So to say that they're going to, not drive as much or whatnot, they're still driving gasoline-powered cars, even if they're buying the used cars, right? Because they can't afford an EV. So you're going to have oil demand still go up for a while. Not a lot, a little bit. Million and a half barrels a day per year. That'll go on for another decade or so. The oil market's about to enter a supply deficit. We already know that. How fast will it happen? Seems like next year sometime, right? So inventories come all the way back down to normal. Still a little bit higher than the 10-year averages. So the 5-year averages are skewed a little bit because of the last 5 years. So if you look at longer charts, I hate when they just do these little charts. I mean, they really should give you some context and back this chart up another 10 years. We still have a little extra oil in inventory, even though compared to the last 5 years, it's less. But compared to 5 years before that, it's more. You kind of see that right here, right? Again, Chinese demand just keeps going up, and they're having some EV problems over there. So, growth in EVs is not spectacular for off brands. Tesla is the only one showing gigantic growth. So, keep that in mind. The first mover thing is still there with EVs. I can afford an EV, and I'm still not buying one because it's just not a good deal yet. I'll tell you, I love the Model S. Love it. And if that Model X, the one that they're talking about, is going to really have 600 miles of range, I'll buy one of those someday, when it gets to a more reasonable price. I'm just not a $75,000 car guy. I mean, I get it, but you know, tell me when it's 45,000. I'll buy a $45,000 truck. IEA saying the same thing. We already looked at this. Add it up twice. So this is what OPEC has been telling us, and now IEA is telling us. Unless there's major new supplies planned for after about 2020, that supply-demand curve crosses again, where demand goes above supply. So that's going to bode very, very well for those Permian stocks, Occidental included. And I haven't even talked about all the other neat things about Occidental. Just talking about the market here. So you're in a, and I know that there's pain because the last few years have sucked in oil, right? You could trade it and be successful, but if you're a buy and hold person, you got creamed. You want to be buying these companies that have this profile, right? That profile that I showed you. Where's that map? Was it page 11? Right? Companies with, where'd it go? Companies with this profile are going to do really well. Powder River Basin companies, Permian companies, companies with legacy assets that they can refrac, or, and here's one of the neat things with Occidental. Occidental is within a year or two of being able to use a different method, an enhanced oil recovery method using CO2 on their depleted or their slowing fracked wells. So a fracked well, really only getting a lot of oil out of it for 2-3 years. Well, when these wells start to peter out a year, 2-3 years from now, Occidental already has the technology almost ready to go. They're still tinkering with it, but they're pretty close, that they're going to be able to refrac those wells, basically get a whole nother set of production, almost as much oil as they got the first time, for about 40% less in price. So when Occidental first bought conventional acreage in the Permian, they bought it with the idea of taking the conventional wells and not fracking, because that's not what a conventional well is, just regular straight down wells, and they would use enhanced oil recovery to increase the production. Well, the kicker to the deal was, by the way, we just have the oil rights, and now we all know how to frack. So not only did they get those conventional wells, which is what that deal was priced on, but they also get all these unconventional wells basically for free. What Occidental is going to get for free out of this deal in 2-3 years is that they'll be able to refrac or use an enhanced oil recovery to get more oil at a lower price, right? Because it's already fracked. And they'll be able to flood these wells with CO2 and get more oil. So there is a lot coming in this deal that's not priced in right now. And when the CEO tells you that it's coming, and everybody shrugs their shoulders, well, it's not here yet, it's speculative. Okay, you can take that approach, and that's fair enough. If you just don't want to understand why they did the deal and you'd rather criticize, have at it. But I'll tell you what, Warren Buffett says this company's going over 62.50. I'd say that he's probably 80% likely to be right. That's his track record, 80 to 90% likely to be right, which is a spectacular track record. If you're not aware, most guys in this industry are somewhere between 40 and 60% right. I'm closer to 60. Kramer is right at 50. Most other guys and women are at 40. So, take it for what it's worth. So I think that is all we have for today. on Occidental. Why we want to be in this Permian Basin? It's because there's a lot of oil companies in here, right? Concho, Parsley, Pioneer. Look how much they overlap. Don't you think that'd be a great merger? I do. I'd love to see these four companies figure out a way to merge. That would be the mother of all mergers, right? Ooh, got to use mother of. All right. So take a look at these companies. I do think, Devon Energy, we know is in merger talks with somebody. Take a look at that map. Take a look at this map. All right. That's Marathon, Bakken, Permian, Stack Scoop, Eagle Ford. I have too much stuff run on my computer. That one doesn't do it. Permian, Stack Scoop, Eagle Ford, Powder River Basin. These guys are Bakken. So they could probably sell off the Bakken asset if they merged. Sell to Continental, sell to Conoco, sell to Chevron, whoever. Encana, right? Permian, Eagle Ford. They're trying to sell this. Occidental could buy that. Bakken, Williston, Duvernay. They're trying to get rid of that. I don't think anybody's going to buy it. Montney, they want to keep that. Stack Scoop. I mean, there's a lot of neat mergers that could go on. And here's the thing about the mergers. The mergers virtually all unlock cost-saving synergies. So it doesn't have to be that you're looking for a buyout opportunity, right? You don't have to necessarily just look for the Permian pure plays who are going to get bought out. Take a look for the companies that are going to merge. These mergers are virtually always profitable. They all save money. They all high grade their assets. They all sell off some non-core stuff to somebody who it's a core asset for. These mergers are going to be a big deal. I think this is the last downer for oil in the next year. I don't know how long this lasts because of the trade war, but at some point these stocks take off. And you just have to be a patient long-term investor, intermediate-term investor, right? Those 2, 3, 4, 5-year time frames. Because 10 years from now, I don't think I want to own any of these. But there's money to be made here for now. And then you wind them down and you move on to other things. Take a couple of questions here, and you can look at that for a minute. So somebody here might be a little bit behind on my writing, but I think Occidental is, if you want exposure to the oil and gas sector, I'm not saying that you have to, but if you want exposure to that sector, and you know that I think that you should have exposure to 6 or 7 sectors, I think Occidental is the one. I think Chevron's okay. I hate the company, but I stay away from them because I do think the litigation risk is real. For folks over on fundamental trends, that I came up with a hedging trade on Europe, a specific fund, because one of the largest holdings is probably going to zero. So if you're looking for a great hedging trade, I think we have one over at Fundamental Trends. If you're looking for other good dividend plays, I think we have those over at Margin of Safety Investing. Those are also at Fundamental Trends, but Fundamental Trends is if you also want to do swing trading. Otherwise, Margin of Safety is a great service. And I'll just throw this out there. The more I study AT&T, the more I like them. I think that they are moving into a new era. I think they're having a paradigm shift as a company within a paradigm shift in their industries. I think AT&T gets out of this range that they've been in mid-20s to mid-40s for the last 20 years. I think ultimately they move into a new range of mid-40s to mid-60s, maybe even higher. They're going to start spitting out a lot of cash once they have their streaming services going. Disney has already jumped on that thesis, but I would buy Disney on any pullbacks as well. I think the big loser is going to be Netflix. I think Netflix has got big problems coming because they're going to lose all their growth in the United States, and then they're going to get chipped away at. And Disney, because they own Hulu now, is going to grow internationally. So Hulu and Disney are going to do some huge things internationally, and AT&T is going to be huge in the United States. So looking for dividends, I think Disney and AT&T are where you're going to see unexpected growth. I think that you're going to see them be able to control their production expenses. Their advertising, they're going to take a little bit out of Google and Facebook, probably especially Facebook. I went on a Facebook break recently, and every now and then I break it, but I break the break. But I'll tell you what, I think Facebook's got big problems too. So I know that Dave Zanoni likes Facebook and Netflix, but I just don't think their business models are all that great anymore. I think that they had huge first mover advantage, and I think that that is over for Netflix and Facebook. You know, one of their largest sources of revenue, which is selling your data, is going away. And that's going to be a problem for them. They're going to have to live on what they actually can charge advertisers. And that is way less than what they've been getting for selling their data. So keep that in mind. They're going to have a very expensive transition. I still think Facebook probably goes back down to around 100 again. I don't think that last dip was it for Facebook. So I would stay away from that. But Google, they just started spinning. They just spun off a little company. Baby Googles are coming. Baby Googles all over the place. Be a lot of baby Googles in the next 10 years. And those babies are worth, billions of dollars. So I would keep an eye on that. Yeah. So I think there's a lot of things. Somebody just mentioned semiconductor, different context, but the semiconductor space is going to be hurt with the trade wars. So we should be looking for opportunities there. NVIDIA and Xilinx, because of their AI platforms, are going to be a big deal, already a big deal. So NVIDIA, if we can get it on a double dip, and Xilinx, which we just missed a couple of years ago, they might come back to us. But the new focus lists that I'm working on this weekend, I'll work on those from my girlfriend's house, while I'm running errands and cooking macaroni and cheese on a soft diet right now. I've got these focus lists that are almost ready to go. And those are the 30 companies in growth and the 30 dividend stocks that they're just the best companies that we can get into. And anytime the market pulls back and we get a correlated correction, we want to buy these companies. So that is probably where I will leave off for today. If you haven't studied up on the Kinder Morgan stuff I put out there, go take a look at that. Kinder Morgan's starting to move. And I think Kinder Morgan goes to 23, 24 imminently. If you have the June calls like I do, you gotta look to just kind of roll those out a little bit. But that stock's gonna go up 25% pretty quick. And I think it probably doubles in the next few years. They're just too undervalued for what they're doing over there. All right. Take care.